Wednesday, September 21st. Stan Ehrlich and market commentary. Good morning. Currently 9:49 a.m. California time. A little later than I normally make my recordings, but maybe we're going to run into the Fed commentary here, which is apparently what the market's waiting for. We have the Spider, my favorite index, slightly higher in the day, 2.3, around yesterday's high. We made it a little bit above yesterday's high, not down to unchanged, and a very small trading range so far, about where we opened. The key here is the high on Monday. That closed a gap from last Thursday to last Friday. Again, gaps are almost always closed. This one was closed very accurately. So that was done. We don't need to rally up any higher than the high of Monday, which was 388.5. If it does, we're still running into a lot of resistance. Remember, I'm bearish. We're still running into a lot of resistance in the area of 390, which I think is going to stop any rallies at this point. We're at 386.5 at the moment. So, another 3 points, 4, 2.5, something in the range, might happen. And it could be because of the Fed commentary coming up. We'll see. Rally or no rally. I am expecting, and I think this week, that we're going to challenge the lows made yesterday, which was the lowest low so far, 381.20, for this particular significant leg down, which started August 16th, way up at 431. So here we're at 386. Having just made lowest lows yesterday, new low closed and moved down yesterday, not even oversold yet. So there's elbow room for lower levels based on RSI use, which I like a lot. This is my custom Ehrlich reversal, RSI, Relative Strength Index, indicator. Wells Wilder taught me how to use RSI, the developer, in the late 70s and throughout the 80s as well. So this is my take on Wells's original RSI. It doesn't plot the exact same numbers. It's more significant, more sensitive, period. So when I get down to 25 or lower, the green horizontal, I claim that the market is oversold, and I also claim the market is ready to rally. The last time it happened for a few days was early September. It did rally very nicely. Last time it got overbought, it was the top of the market. Another occasion where it got oversold, it was the bottom, and it has been the bottom so far for this bear market, June 17th. So this indicator helps me a lot. Here's another low overbought condition where we were just a little early and then it bounced. Usually it guides me to almost the exact day when the market turns around. Now, bounce or no bounce, I'm looking for lower lows, and I'm expecting the market to come down into October. Why? Well, I keep saying that there's a very strong historical seasonal, which there is. The green bars represent the time frame for October. The little arrows represent the exact week. This is weekly data when the S&P or a spider bottomed out. Frequently during the month of October, and if it's not, it's sometimes only maybe a week early or maybe a week late. Rarely does it not have any significant low whatsoever in October. It almost always has done so for over 30 years. The percentage is in the high 80s, low 90s for the likelihood if the same percentage continues. So we've got a couple of weeks to go, and then we're going to be watching for oversold conditions. We're going to be watching for reversals. We're going to be watching for telltale signs that the market's going to turn up in October. I will scream bloody murder at the time. Stay tuned. I will also try to forecast how long it's going to last and how high it's going to go. Fun, fun, fun. Forex. This is almost a new low for the whole trend down for the euro. We are now actually under 0.99 or 99 cents to the dollar, meaning it's cheaper to spend money in Europe than the United States by a penny. Indication of, I don't know, Ukraine's nuclear problems, economy, other factors. I am not a fundamentalist. So it doesn't really matter to me, only the way the market moves. Let's look at the bonds for a moment. This is a 30-year long bond. Code is US. We are very close to the previous lows that we made back in middle of June when it was oversold. We are now, guess what, oversold again. I think there's a chance we could have a double bottom here. If that happens, then there's going to be a very big rally, so it doesn't seem to fit the bill as far as my inflationary, recessionary, bear market trend expectations are concerned. So if there's a bounce, I don't think it's going to carry very far for very long. Maybe 135, 136, something in that ballpark, and then down again. My opinion is that we're not going to be out of this bear market until late spring, sometime summer next year. Let's look at some futures contracts. I have a brand new sell signal on platinum today in progress. We have an outside down day, a bearish engulfing. We were overbought, just barely, but overbought. So that matches. And if this signal works, and they don't always work, and we always have a stop, absolutely, unequivocally, emphatically, always have a trailing stop, money management. So if this signal works, I'm expecting a move down of some significance in platinum. We'll see how it pans out. Here's my last signal, a bullish one, worked out pretty good. Here's another one, it's a bearish one, almost on top of the rally, also pretty good. I'm going to go back to the indexes for a moment. Slipping slightly, we're still up about 2 points on the spider. Let's see what the Fed has to say. If there's a rally, I'd be looking for sell signals on the rally. If there's a break, well, heck, I'm just expecting it to Tierra del Fuego, head south. Thank you very much. Stan Ehrlich. Have a great trading day.